Morning. First of all, I would like to thank Dean Henry and also particularly thanks for you and for the invitation. And it's a great honor for me to be here to say a few words to this very distinguished audience. What I'd like to do is, since it's in China, and I was asked to talk about a little bit of China, but I would like to put the China in a more broad background. So I'm going to bring two things together, which is the changing world and the changing China, and how China fit into this changing world, and what will be the main challenger as well. I will talk roughly, now it's exactly 10:30, 30 to 35 minutes. We'll be more than happy to entertain questions as well. The first issue is the changing world. The world has been changing dramatically, exactly as Dean Henry mentioned in his book and in the previous sessions. And we at the fund obviously also try to see in what aspects of the world has been changed. So what we try to see is the world really changes in many multiple ways. So the first issue is what we found is very interesting. After 30 years of globalizations, every country with different strategy, different positions, they change their position in the world, which reflect the change of their position in the global map. So this is a very interesting map. This is a map defined by geographic area. This is a map we thought every day. This is when we're born, we see this map, so every day it sounds like it never change at all. Now, what we try to see is if we size country by GDP, how map would change. Indeed, the map changes quite a bit. So if you're looking for Russia, Russia's here. You will see if we buy GDP, Russia becomes very small. And the US and China become big, and Japan, obviously by GDP, is bigger than its geographic areas. But that's not the whole story. What we further want to see, if we want to define this by trade, how the map will further change. Indeed, the map changes again. You will see the Europe become huge because inter and intra-trade between countries among Euros. But also further, we want to see, because today is very much a financial world, what we want to see, if we weigh the country by financial activities, but let me say again, it's not assets within the country, but rather by cross-border financial activities, how the country will change. Indeed, the map changes again. Look about China. China's here. China become very, very small. And we want to get, what is this country? Dean Henry is going to offer 1 million RMB for the right answer. Switzerland, unfortunately, was wrong. So you have to pay me 1 million. I'm getting 1 million now so far. It's not a bad deal. Exactly. It's Luxembourg. Can you imagine Luxembourg, such a small, UK become also very big. But anyone together, what is this? Because I just gained 1 million, so I have capital. It's a Hong Kong. Can you imagine in the global financial map, how small is China and how big is Hong Kong? More than that. It's not only change a country's size and position in the global economic financial world, but also change the linkage between and among countries as well. So go back to the map again. What we found is the country have a different group, which is quite different from Dean Henry's the Third World and the First World. And you will see the country after 30 years globalization groups them together. The big group is this advanced economy. I call it cluster. The cluster one, you will say advanced economies always groups them together. I will tell you, no, not necessarily the case in just a second. But that's the first group. The interesting also the second group, I will call Pan-Asia Vertical Supply Chain Group, which is Asia and bring more and more other countries into this group. You probably will not believe Brazil today belongs to this group, and Chile today belongs to this group. And the third group is the energy group. They are in very different areas like Nigeria, Kazakhstan, Saudi, and Russia. They all geographically different, but they share the same characters, have same economic policy, more or less they have the same business cycle. They become the one big cluster. The world today becomes three big clusters. It's very interesting. What really happened is, in the advanced economy, it is US is moved to the West to the Europe. So advanced economy become ever closer. And in the Latin American area, it's also changing. What happened is the north to the Panama Canal is all the countries more or less are still associated with the United States, but any country south to the Panama Canal move to Asia. We never, ever observed that type of change before. Because the US is typically associated with North America and South America, a little bit of Asia, not necessarily close with Europe. But today. Now let me show you the change even in the advanced economy. This is in Europe. What we try to do, how Europe changed country relationships in the past 20 years. Indeed, the Europe plays a significant role in these areas. You will see between the 84 to 99, in these times, in Europe, there's two centers. The southern center is France and Italy. But anyone guess who's the northern center? 3 millions. You offer 3 million RMB for the right answer. Your local hoster, obviously, here's a lot of RMB. Anyone want to get who is Northern Center? You guys not an MBA, too shy. It's UK. Before the Euro, UK was the Northern Center. But what happens after the Euro, it really changed. So in 1990 to 2011, all the countries grouped together, there's a one core. Who is the center? Germany. Euro changed the whole European economic and financial situations, changed the whole interrelationship among and between all the countries in the region, and has a profound impact on global economic and financial structure as well. More than that, what we found is more interesting, not only the countries change the position in the relationships, but also the way they link to each other also changes. I call the cluster structures. When we call the cluster structures, you will see a small cluster here, a small group of countries. That's the gatekeeper. The gatekeeper will bring the country to the big cluster, and the big cluster bring to the another gatekeeper bring to the core, which is the core. So it is not a linear relationship like a country to country, city to city. Not everybody go to New York, although everybody want to go to New York, have MBA in New York, Stern University, but not that way. Actually, it is a small group who link, and then reach to the end. It's very interesting because it is a multi-dimensional relationship. So that make the interconnectedness become ever a phenomenon. So take a case, for example, there are 6 small clusters here. And you will see within these different small clusters, they share one common gatekeeper, which is Italy and Austria. So Italy and Austria will bring Greece, Bulgaria, Romania, for example, which is a small cluster, Poland, Slovakia, Hungary, and Czech is another small cluster, and bring them in, as they bring them to the core German, France, and UK in the Europe as well. So you will say, why Austria? Because Austria-Hungary Empire. History do come to us from past to today. What most interesting we found, the business relationship is not what we thought just one today. It's really rooted deeply in the past. So it's a mapping into today. So it's all the economic linkage, economic network exists in the past 100 years and reflect today's transaction and interconnectedness as well. So this is also very interesting things. Because these new cluster structures, the interconnectedness become ever a big issue we are facing today. For example, what we see the co-movements between the equity market, currency market, bonds market among themselves, you see, the starting point roughly 10 years ago, the coefficients of co-movements in this market roughly 40 to 50%, but today, and 70 to 80%. So you will see across different areas in the same market, so we move in the same direction in very high coefficiency, which never happened before. And the most interesting you will see during the crisis, for example, 2008, because the contingent effect have a vertical moving upwards, coefficient correlations enhanced dramatically. But obviously, most interesting you will see the bonds market doesn't move because the dollar is the safe haven. Money moved to another way. This is also the thing we never observed before. And this is a 5 regional equity market. If you're looking for the green one, which is Latin American equity market to emerging Asia, you will see 10 years ago, the coefficiency was about 42%, but today it's 81%. Thank you, that's fine. Have a coefficient like 81%. They move together, they're thousands of miles apart away. You will see they behave very different. So Asian people working hard, saving Latin American, enjoy life, dancing and singing. But they have the same investment behave. Why that happen? The answer is very straightforward because the whole part move to the Asia become the part of the pan-Asia vertical supply chain. The real economy moving, the financial sector follows, which is also a big change. The most interesting we will try to say to see how this major economy, Europe, US, China, Japan, the UK, they have the spillover outside their countries to the others. US is very interesting. If it's a macro shock, that means it's a real shock, supply shock, monetary policy, fiscal policies. The impact to the outside world is relatively small. But if it's a financial shock, you will see the impacts are much bigger, and particularly from the United States and from Europe. So the whole interconnected, the impact and the channel, is a financial. And we try to decompose see how much the US will impact on the side of the outside of the wall. US is also very interesting. If it's a real macro shock, because a major US 1% real shocks by outside is one's Canada, one's Mexico. It's easy to understand. But the third major one is Saudi. It's hard to see. The fourth major one is China. So the US has the most strong spillover impact on all those countries, but most strongly for these 4 countries. But if it's a real shock, but if it's a financial shock, you will see the magnitude increase dramatically, immediately about 50%. We did a study, we tried to see, let me skip this one, given the time limitation. We did a study, we tried to see how much external impact on domestic macro or GDP growth variation, which is let me restate again, how much external shock impact on domestic GDP growth variation, which is the trend on variations. It's if you're looking for China, just before crisis, roughly external shock had a 30% impact on domestic Chinese, 35% domestic GDP growth variations. After crisis, 70%. Okay, you say China is an emerging market, it's big, but still emerging market. But if you're looking for the United States, it's absolutely stunning. Before the crisis, the US has only 15% roughly the impacts from outside shocks for domestic GDP growth variations. Relatively small, US is a big economy, very much self-sustains, so that's okay. But what happens after the crisis, the external shock play more than 60% to United States domestic GDP growth variations. Wow, USA. How come? So the question is, how do a country do independent domestic macro policy? If the US had external shock play more than 60% of domestic GDP growth variations, how can one single country to manage its own domestic independent macro policy? That's exactly the challenge you are facing today. Meanwhile, another chance happening is a global growth gravity shiftings, as Dean Henry mentions. You will see the growth roughly more or less before 2000, a little bit of 2001, 2002, but afterwards the growth really separate. And advanced economy growth has remained roughly 1.8, 1.7%, and emerging market low-income country remain about 6%. So 3% GDP growth gap continues for the roughly in the past 10 years. Because the different growth rates in the past 10 to 15 years, it changed the global economic structures. It's also fundamental. This year is the first time you will see the emerging market will have the global GDP share, PPP measure still over 50% this year. This is 2013. And it will continue to go upward advanced economy share in the global economics where it drops. This is pivotal. This is pivotal. Because anytime when you say before you say advanced economy have a slow growth, emerging market have a strong growth, but they are small. So they don't play global impact. But when emerging market income countries have the global GDP more than 50%, and their growth rate is 3% average year higher than advanced economy, they change the whole global demand function, change the whole global demand equation structure as well. The whole story is, there's 1 billion people living in the advanced economy. There's 6 billion people living in the emerging low-income country. When 6 billion people have their income increase every day, day by day, the demand increase strongly, the demand structure increase strongly. So they change the whole world demand equation and demand structure. They drive the whole world demand structure change. That's the most important market features we observed today. Yeah, I can give you a lot of examples, data, but I'll save that. And so you will see emerging market roughly after crisis contributed 2/3. The blue is advanced economy GDP growth rates, but that's not the whole thing. The most important thing is they contribute more on the consumption, because the blue bar is advanced economy that contribute to global consumption growth. Roughly before the crisis, always more than 70%. After crisis is today, roughly half. And the low-income country and the emerging market contribute more than half, and global trade growth as well. The world is really changed in that sense. And the deleveraging and the growth is another feature we are facing today. You will see the world has quite heavy debt burdens, particularly in the advanced economy. This is 2008. Compared with 2008 to 2013, you will see in a lot of advanced economy, the government debts increased quite a bit. But meanwhile, in the low-income countries, emerging market more or less stay the same, even drop a little bit of that. But that's not the whole story. It's not on all the public debts, but also the household debts is way high. So in advanced economy, this is the UK, the household income to disposable income ratios increased to 170%, dropped to roughly 155 today, still way high. And the US is when drops roughly 120, and the Europe is on upside as well. So household, the debt is also high. Not only that, the corporate debt is also very high. You will see, compared with year 2000 and 2010, you will see the corporate debts in the advanced economy, particularly in Europe, is way, way high. The two countries' corporate debt does not change, increase very much, is the United States and Germany. When the household debts increase, the government debts increase, corporate debts increase, obviously, the banking debts increase as well, so banking leverage ratio increase. That's exactly what we observe from this chart. You will see in Europe, the leverage ratios numbers times from roughly 36 times drops, 25 times, still way, way high, which you convert into the Basel, roughly less than 4% capital requirements with the non-risk-weighted assets as well. So we are overall in an over-leveraged society, so debt ratio is so high. But that's not the question. The question is, you have a high corporate debt, you have a high household debt, you have a high government debt, you have a high leverage, the banking sectors, you have to go through the deleveraging process. But when you go through the deleveraging process, the government cut the deficit, they cannot spend money, there's no aggregate demand. The corporate rebalance their balances, they don't invest. The household, they try to clean their balances, they save more, they consume less. So add them together, they generate a very weak global demand. Aggregate demand is very weak, so that's the reason we have very moderate growth as well. And it's not easy for the country to get into the 100% GDP of a government debt to get out. We did a study in the past 135 years for 43 cases, 1873 to today. It's the 43 cases we found if a country have a government that's over 100%, unless it's during the war situations, because after war, the production increased, the death ratio dropped quickly. It's Israel and other war situations. Otherwise, it's very difficult to bring the debts down. So debt's overhang is really another major challenge we're facing today. And it's not easy to solve. There's a case in Japan when the Japanese corporate debt is more than 380 times of GDPs, roughly before 1990. The corporate understand that they have to clean their balances. They cut their debts dramatically. You will see GDP drop immediately because no aggregate demand. So what the government tried to do, the government tried to provide a government debt to issue bonds to support aggregate demand. So aggregate demand increase, they maintain the GDP in a certain level, still very volatile, but meanwhile, government debt level increase dramatically. So public debt substitutes for the private debt is not a good solution at all. We have another story from UK. You will see after First World War I, you will see the UK, the deficits are around 23%, 4%. The UK government did austerity policies, bring the debts over to the surplus, but GDP drops quickly. But then the government issued a bond to support, but the debts increase dramatically, then volatile here, and the GDP also doesn't change very much here as well. So historical case, you will see, is very interesting. The government, the debt substitute the public debt is not a good way to get out. This is US case. I'm going to skip that one. But the more interesting fundamental changes here is a global structure change. What we found is also very interesting. In the past 20 years, from 1990 to 2011, in the advanced economy, the total consumption is from 76.3 increased to 81.5%. The increase is 5% of GDP. This is a big C, right? We all had Econ 101. I assume Dean Henry, you offer them Econ 101. Okay, you have a big C increase 5%, so what do? Because you have only 100 added them together. So you have to drop in your investments, which exactly happened. Investments in advanced economy dropped from 23.7 dropped to 18.8%. But that's not the story. The story is what really happens in the emerging market. You will see their consumption, when advanced economy increase their consumption, the emerging market drops their consumption from 7.3.5% to 6.4%, more than 7%. Meanwhile, they have to, that's exactly happened, increase their investments from 26% to 31%, another 5.4%. You see, it's such a beautiful, beautiful world. Everything have to match to each other. Everything have to balance to each other, right? So what happened is, in the past 20 years before the crisis, when advanced economy increased consumption, they have to drop the investments, but mirrored by emerging and low-income country to take its advantage to invest more and produce more to export to the advanced economy and reduce their own consumption. This is absolutely, absolutely amazing structure shift. But that's past. The questions for today and for tomorrow. The first question, can this 81.5% of GDP consumption will be able to stay? The answer is no. Because you cannot live beyond your means. But if you cannot stay, the second question is, how much do I go back? The answer is, don't know. Because when you get high living standards, it's very difficult for you to move back. But the real question is, if advanced economy reduce their consumption from 81.5%, go back this way, and they have to increase their investments, what happens on the emerging market and the low-income country? They have to increase their consumption, reduce their investments. Can they do that? The answer is you have to. It's a must, because as simple as everything have to add them together as 100. That's the Econ 101. But can you manage the process? It's not all clear. So bring them together, I think it's very interesting to see today in the whole world. The world changed dramatically in the past 20 years, 30 years. Every country, because of strategy, resource, they change their position in the world, they change the map. Also, the world changes the group and changes the way they link to each other, become the cluster structures, which dramatically increase interconnectiveness, and which make the spillover become such a powerful fact in today's economic and macro-financial life. And the shifting growth gravity is a big trend happening in the past 20 years, will continue to happen in the next 10 years or so. And the global structure shifting and the reshifting will bring a more dynamic world to everyone here. So, welcome to this very exciting, very challenging, very dynamic new world. What about China? China is also changing. The China grows strongly. You will see roughly 20 years ago, China's GDP only account global GDP 4%. Today is 14.4%. So China's GDP is more or less equivalent to the Euro area GDP, which is quite big. And China's in the global share is roughly 10%, equivalent to the United States, which is absolutely amazing. So China become very strong and very big too. And also, China become more and more, many countries, the destination for the exports. So this line is between, this is 2001, it's 2011. In 10 years, for example, it's the Philippines. In 2001, total Philippine exports is roughly 2.5% export to China. Philippines. After 10 years, today, 23. So in 10 years horizons, Philippines export to China, in terms of their total export shares, increased 10 times. This has happened almost in all the country. You will see every country is beyond that line. That means in the past 10 years, they export to China more, and their linkage to Chinese market becomes stronger and closer. And so that's the reason we'll see the export to China contribute 26.3% of Japan GDP growth in the past 2009 to 11, and in 19.1% of Korea GDP growth in the 3 years past, and 14% for Germany as well. So China really become the global growth engine now because the market and because of the demand. If China slows down, what will be the impact? We did a study where say, if China investment slow down 1 percentage point, will cause a 0.9% GDP growth drop in Taiwan, China, and Malaysia roughly 0.6%, and Korea. Once again, this is not two side to side. It's a 1% Chinese GDP drop against a 1% Chinese investment drop against the other countries' GDP drops. So it's not a GDP to GDP. China has a 47.1% of GDP of growth. How much is that can drop? And how much that can impact on the trade partners' growth? And the same thing for the commodity export country to China, you will see the same thing. If China still, the investments slow down for 1 percentage point, you will see the most things you probably will not see that. You will have a roughly close to 0.4% GDP drop for Chile, Zambia, Saudi, Kazakhstan, Iran, and Australia. So those are the commodity exports to China. And because they're so linked to Chinese market, if Chinese investment drops, will have a profound impact on their growth as well. And China become the global trade center now. Go back to the previous cluster structures. We try to mapping the European trade with China trade. You will see this is Asia, or with Asia. This is Europe. But you will see it's really all the Asia travel more or less through China, because China is both gatekeeper and a core for Asia and for the whole world. Bring to the course here is Germany and the UK and France as well. Also, you will notice the US is also here. Geographically, the United States has nothing to do between the trade between US or between China and Europe. But US is such a big economy, economically and financially, US is still the core. So China is really a core for the global trade. I can show you another one for China is for the global machinery clusters. You will see this is different areas. This is Asia, this is Latin American, this is Europe. You will see the core actually here is China bring to the Asia to the core, and this is it's Europe, and the US bring Latin American to here. The core is here, which is US, China, Germany, and the France and the UK is here. The core is here, yeah. So actually, Ding Harrier, it's not my fault. I guess people cannot read it because you need a 10-time big screen next time. Yeah. And this is the real picture, because the distance means the economic and the financial linkage. It's not sort of just a dry picture as well. And China is really in the core. So today, I think the point is the Chinese growth become the public goods of the global economy and financial stability as well. It's like the United States. The US growth is a public goods for the whole world, because China plays such an important role in the global aggregate demand. And China's financial sector also grows strongly. You will see in the whole world, China's share, you will see here, And in 2002, the total China's financial share in the whole world, roughly only 2%, and 2011 is 8%, but still way behind China's GDP, 10.5% in the whole world. So Chinese financial sector still relatively small. But if you see the banking sector, the Chinese banking sector accounted 13.1% of global banking sector assets, which is almost close to the United States, which is 13.3% global banking assets as well. So you will see Chinese banking sector is very big, but overall the others and the bonds market, particularly the bonds market, still is relatively small. But the financial sector grow very, very strongly. And you will see in the past 10 years, and in terms of the whole market structure, Chinese banking sector is still very much in the banking 69.9%, and equity and the bonds market still the relatively small, and equity market also very, very much small. And in terms of percentage of GDP, 282% today against the global level, 366%. That means China still have a lot of room to grow in the past and in the futures, and which is the case. You will see Chinese financial sector grow strongly. In the past 10 years, GDP growth of 500%, which is nominal, and the financial sector increase of 708%, which is really the leading number in all the region. The whole world financial sector growth rate is 170. So it's grow very strongly. But China has its own issues, because as a transitional economy, the first major challenge is the capacity is the utilization is low. Because the capacity utilization drops roughly in the early 90s from 90%, and particularly after crisis, and because the capacity increase, today the capacity utilization dropped to 60%, which is way, way low by all the means, which obviously means the profitability, you guys know more better than I do, and efficiency as well. And you will see the product market still not there. So this is a zero international level. So China's water price, China's here, roughly 70% is below the global average, and China gas price is roughly 50% below the world average. So there's still a government subsidy in these areas, and the product market still not fully functioning. And the capital flow is another interesting issue. You will see in the past 10 years, from 2001 to 2010, China receives 853 billion of FDI. But wait a second, look this number. China also exports 2.7 trillion, the low risk capital as well. So net, actually China exports $1.8 trillion capital. Let me re-emphasize, $1.8 trillion capital. This is China's net capital position in the world, which is also a big features. But the financial sector facing challenge when they grow very strongly, the banking loan grow very strong. You will see this is all the country, Malaysia, Japan, during their peak growth periods. But compared to China, the loan level is way, way high than all the countries in the region and in the world in their peak growth periods. China's roughly around 150% of GDP. And the social financing increased dramatically. I see my moderators anxiously stay there. Let me finish in 2.5 minutes. I'll bring you back. This chart is interesting because this chart will say the blue bar is the total social financing loan, banking loan plus scheduled banking loan together. You will see increase dramatically, and the investment supported by this financial support and increase dramatically. But when investments increase, the GDP does not increase, but rather drops. This chart is very important. Just say the marginal productivity for investments become very low today, which is a big issue, which means China have to change their growth model as well. The investments are way high and consumption in China is way low. I'm not going to go through that way, but let me go through one thing for you. Yeah. What we observe is, this is the China here. This is the combined consumption and investments ratio. China's private consumption is very low, 35%, and the investments are under 45% in 2007. But what happened today? Does China move into the right direction? Which direction is the right direction? Wow, I guess I need to offer 4 million RMB so we'll have a right answer. The right direction is to go through this way. But what we see, please, if we look in the map, we will see China moving to that direction. So that means from 2007 to 2011, China has a less consumption and more investments, which make the growth model even harder to adjust as well. So put them together, I would say China become a bigger economy and become the global drive force for the aggregate demand. It has a profound impact on many countries for the trade partner and the commodity export countries as well. I think that's become ever clear. And there are many rooms China can reform, move forward, so I'm going to not go through the whole thing. But let me go through the last few issues I was seeing, the 10 most important reform agenda for China. I think the few things for China is the most important thing today to do is, after 20 years and 30 years very strong growth, China get into today's global position, become ever important global economy powers in the world, but also facing tremendous challenges. The few things, changing the growth model become ever clear, and invest in the R&D to move the value chain, make sure the manufacturer and the supply chain will be able to sustainable and move further. I think this is also very important. But I would say the last issues for China to facing today is China need a new lifestyle. Because it's become ever clear, you cannot have a 1.3 billion people, everybody move into the American lifestyles. Everybody have a big car, big house, big land, because we don't have that resource. So for the 1.3 billion people move into the middle income and high incomes, you have to think about what will be the lifestyle the Chinese people will have for their life. China have to create a complete new life model for themselves, which could be very different for any life model we observe today. For example, the environmental issues become such a key issue, and we have to take that into the considerations. So adding them together, the world is changing fundamentally, dramatically. China is changing fundamentally and dramatically. But both of them provide a very dynamic situations and the world and challenging for everyone in this room as well. Thank you very much.
Thank you so much. A profound presentation. You all didn't know you'd be returning to a lecture hall, did you, so soon into our conference? But we're fortunate to have such really leading-edge thinking on the world economy and China. We have just a few minutes before we go to a break. So these thoughts, figures, ideas, and provocations will feed into our next panel and the next 2 days' worth of discussions and debates. So rest assured, we'll be taking advantage of your insights. But just in a few minutes that I have, I'm going to take the moderator's prerogative just to grill you on a couple of things. You talked a lot about connectivity, really one of the uber themes of your presentation. Are we at a point where we can say the thesis of decoupling is now debunked?
You actually have two key issues, the decoupling and the productivity. I think the decoupling is, it seems to me, a must process, because the whole world is borrowed too much. You cannot live beyond your means. It's become ever clear. And so when you go through the deleveraging and the process, and emerging market have to pick themselves and have to move away from the more external demand-driven growth model to more internal growth-driven model, the decoupling happened in that sense. But it doesn't mean it's a reduced interconnectedness. What we found is very interesting. Last year, trade growth is on 2.4% for the whole world. You will say it's a decoupling, globalization slowdown. Yes and no. Because our index for interconnectedness show the global interconnectedness actually is increase rather than decrease. There's two different concepts. The decoupling in the sense you depends on the real flow for example, trade and financial or capital may be reduced, but your influence, your impact to each other increase. So two things happen at the same time.
When we talk about China, the most striking slide for me was when you resized based on financial interconnectedness. And China became extremely small. Obviously, Hong Kong became enormous. One of the main items on the agenda for reform for the new government is liberalizing the capital account. Can you talk about what this will do from your analysis just presented in terms of risk, in terms of volatility, for what you have called a public good, that is China's growth and stability is a public good for the world economy. If the government were to progress, as many people hope, with this kind of reform, would it increase risk? Is it inevitable?
No, that's also a good question. The map shows, let me say again, it's a cross-border financial activities. It's not the financial assets within the boundary. They don't move. So in that sense, China is very small. Hong Kong, China is very big, right? And it also shows China need to more open up to become the part of the global financial system as well. I would say China is moving to that direction, right? You will see with the current account openness, and with capital account, roughly 43 items today opened 34 already. So it's moving to that direction, internationalization of the RMB, I think, the part of the process.
But softly,
exactly.
But slowly.
Slowly.
We still see how small
exactly,
that picture is.
Exactly a point. What we observed historically from all the parts we see, the financial liberalization, in many cases, is associated with the crisis. So you've got to be very careful to manage this process. I think that's the way Chinese government is managed to go through. Actually get the support from international community and as well.
The last point I want to ask you about very briefly, because I'm being challenged by the minders to get us to the break. You mentioned, for example, the Rogoff-Reinhardt threshold in one of your charts. Many of you will know there has been an ongoing debate and discussion about austerity and the role that it plays and high levels of public debt. The dean made reference to it in his discussion, saying discipline is not the same thing as austerity, although it has become conflated with that in many circles. It's quite a controversial point. The Rogoff paper itself has been called into some question. IMF historically has been associated with austerity, so I'm putting you in the hot seat here, including with recent questions about handling Greece and so on. Tell us your view when you talk about this threshold and the need for austerity. What is the new thinking at the IMF on this?
We're always honesty. And,
we're among friends here. Please, speak freely.
We need both. You're from the Economist, right? And we need both. We need authorities, we need the growth. When a country, company, a household has high debts, I think it's become ever clear. So I won't put the two things conflict to each other as you are presented. We need both. When you have a high debts, when you think about it, you access to the financial market, you have to have a certain austerity policies. Make sure you earn your credit market trust. You have the medium-term consolidation plans. You will be able to go back to raise money. Because today it's become ever clear, you have to access to the market. Otherwise, you're out. So rebuild your credentials is absolutely important. So you need the austerity policy as well. But meanwhile, particularly in the Euro case, when you you don't have the exchange rate flexibilities, you don't have a monetary policy the flexibilities, the austerity will have a big impact than any empirical work showed in the past. So that means you need to pay more attention on the growth side. It has all the instruments to make sure the growth also support What we found is that a lot of what we call the smart fiscal expenditures will be able to support the growth as well. So for example, in the EU, in the Europe areas, the study shows if we do the structural reform, the labor market reform in the retail, all those areas, we'll be able to generate 4.4% GDP growth for 5 years, which is not trivial. So we need to pay attention on both growth and austerity, but also pay more attention on the structural reform, which is really lacked in this financial crisis, because we always see in the past few years on aggregate demand side. But really, since to pull out the economy out of the crisis,
right.
It's a structure change.
So
it's a productivity.
Policymakers have often reached for austerity as a way to win trust. It's an easy tool in the toolkit. But as you point out, there are other things that can also be used to win that trust, which Dean Henry talked about, that give flexibility. I think on that provocative note, I think I'm going to ask you all to join me in thanking our distinguished visitor, ZHU Min. Thank you so much.
Thank you.
We'll be discussing your presentation. Let's all retire for a coffee in the next room. Thank you very much.